the situation where we're working with Jim, and I know he's got all his money tied up in these properties. I don't think he had understood how the DSCR process works. And I mean, I think if you are looking to add to a rental portfolio and you are kind of, I guess, capped out on your income, that would probably be the easiest way to do it now.
It is. Right now you have a lot of investors that want to continue to pick up properties, but they already own 5 properties.
Yep.
They're utilizing our tax laws, right, to its fullest advantage in terms of how much taxes they're paying. So they're writing off things like depreciation. They're obviously, writing off all of their other legitimate write-offs, and they're not showing really any actual cash flow on paper. Therefore, by traditional circumstances, they're not able to buy an investment property.
Yeah.
Now,
if the government thinks you make no money, the bank also agrees that you make no money.
Now we have these DSCR loans, right? Debt service coverage ratio, which really just means that we're not looking at anything else. We're only looking at, and again, in Jim's scenario, all we had to look at was the property he was buying. Yeah. What the mortgage payment, like what the full mortgage payment was, the mortgage, the taxes, and the insurance against what the net operating income, is on that property. So I think with his circumstance, the property was bringing in, I think we had said like $4,900 a month.
Yep.
And we had his mortgage payment, I think, at like $4,700 a month with taxes and everything. Now, even if that mortgage payment was higher, because of how good Jim's credit was, because of how good his credit is, because of the fact that he had more in terms of liquid funds, right? Like as an option for more money down.
Sure.
We could have either went in the direction that, let's say, the mortgage payment was well over $5,000, but the income coming in was still only that $4,900. We can go up to only 75% coverage. So these loans, and with his credit score as good as it is, he wouldn't even really have a higher rate if the debt service coverage wasn't 100% coverage, but let's say it was only 80% covered. He could still get that loan, and we're still not looking at any of his old portfolio. So all of those losses that he's showing and taking advantage still of,
it's just specific to that one house.
It's just specific to that one, and what a lot of investors, kind of get caught up on until we explain it is, I'm paying a 1 or 2% higher rate than what I would be on a regular traditional investment property if I'm buying it through Fannie. But the reality is that by them still being able to write things off the way that they've been and utilize the tax code to their full advantage,
they're still making money somewhere else.
They're making more money by doing it that way.
And they still get to pick up the property.
Yeah, and I mean, again, it's more of a write-off on that property moving forward because they're able to, it's obviously more against it.
Is that specific to only somebody who does carry multiple properties?
No.
Can the average Joe do DSCR?
They can. They can.
You don't need like a large...
You don't. It's just that it's obviously more attractive to that guy because they've bought enough properties to where they know how grueling it can be.
Yeah.
You know what I mean? Showing all the documents that are, for those 5, 6, 7 properties.
Yeah. And then trying to figure out what's been filed, what hasn't been filed.
100%. But then let's even go a step further and say that, let's just say, Jim, it wasn't a matter of him writing off too much. Let's say the guy had all the income in the world, but he already owns 10 finance properties.
Yeah.
Now Fannie and Freddie won't touch it anyway. So now DSCR is that only option, really.
Gotcha.
So there's a lot of reasons why you use it, from being somebody that's not a seasoned investor, that maybe they just own a primary and this is their first investment property.
Yep.
They don't want to go through that hassle, or they just, for some reason, don't think that they need to.
Yeah.
It's a really great alternative. And it's still safe as us as a bank, right? Like, that's why these loans are existing now, is because we're not letting these things go off with no down payment.
Well, if it was super duper, like if it was that slim of a margin, the loan just wouldn't get approved to begin with.
That's it.
That's all it is.
Yeah.
So if there's enough room, the bank is going to take the risk. If there's too much risk, the bank's going to say thank you, but no thank you.
So, just to for other people to understand, Jim came to you saying that, Kurt, I really would love to continue to add to this portfolio, but we ran into this problem 2 years ago.
We're out of money.
When the rates were lower and I couldn't qualify. Nothing has changed, with my taxable income since then. If anything, it's probably only gotten a little bit worse.
Yeah.
So he was like,
that was the case,
figure out a way for me to buy something and we're good.
And we're in business. Yeah.
He's under contract now, and you know what I mean? He's closing on a property that's almost $1 million and is already in talks, right, with you about buying a second, a third, a fourth, because now he's ecstatic about like the fact that he's not only able to do it, but it's actually been an easier process than what he remembers, you know, over the last 10 years that we've worked
Cool.
with him.